In the span of 48 hours, one rule change turned a record-setting metals rally into a forced liquidation event. The exchange that sits at the center of global precious metals trading demanded dramatically more cash from traders, and the market responded the way it always does when leverage gets yanked away. It sold first and asked questions later. On Friday, December 26, 2025, CME Clearing published Advisory 25-393, an update to minimum performance bond requirements. After the close, on Monday, December 29th, the initial margin on the COMEX 5,000-ounce silver futures contract was lifted to $25,000 from $22,000. $3,000 doesn't sound like the end of the world until you remember what a futures contract is: a huge notional position controlled with a relatively small deposit. Then, in a move that almost nobody expected that quickly, CME followed with another notice just 4 days later. The price response was immediate. Silver, which had been trading near the kind of levels people associate with history books, dropped sharply on December 29th, with reports of an intraday fall around 11% on COMEX. Gold fell too. And the part most people miss is that the selling wasn't a vote on whether silver should be worth this much. It was a mechanical response to a new collateral requirement. Here's where it gets interesting. Margin hikes don't just cool a market. They change who's allowed to stay in the market. If you were holding one silver contract, the difference between $22,000 and $32,500 is $10,500 in fresh cash. If you were holding 10 contracts, it's $105,000. If you were running a book with hundreds of contracts, the number becomes institutional in a hurry, and the demand for cash doesn't wait for your opinion. It arrives as a deadline. Welcome to Macro Decoded, the channel where we translate what the market is actually doing before it becomes a headline. If you like analysis that connects filings, positioning, and price behavior into one coherent story, you'll fit right in here. And as you listen, drop a comment with where you're watching from, because the silver story looks very different depending on whether you're sitting in New York, London, Shanghai, or Mumbai. Now let's reconstruct the event with forensic clarity. That phrase shows up again and again in their notices because it's the correct institutional language. But what matters is the sequence. Advisory 25-393 was dated Friday, December 26th, and set to be effective after the close of business on Monday, December 29th. In that same notice, margins in other precious metals were increased as well. Silver's initial margin moved to $25,000, and the higher risk tier moved to $27,500, setting the first domino in motion. By that Monday, the rally had already become a story of extremes. In 2025, gold futures had surged about 65%, and silver had more than doubled, with silver moving from roughly $30 early in the year to brushing up against $80 by late December. That's the kind of move that brings in momentum funds and retail narratives at the same time. It's also the kind of move that makes a clearinghouse stare at its models and ask a simple question. If this market gaps, will every participant be able to pay? The initial answer was the first hike. The second answer arrived on Tuesday, December 30th, when CME issued Advisory 25-399, effective after the close of business on Wednesday, December 31st. This time, silver's initial margin was lifted again to $32,500, with the higher risk tier to $35,750. Read that again slowly. In the space of days, the deposit required for one contract became comparable to what many people earn in a year. And it happened right as liquidity thins out into the holidays, when risk desks are less willing to extend credit and dealers are less willing to warehouse volatility. That combination explains why the selling didn't just appear, it accelerated. When the first margin hike hits, traders still have choices. They can bring cash, they can hedge, they can cut. But when the second hike hits immediately after, the choice becomes binary. Either you are fully funded or you're forced to shrink. You could see the ripple effects outside silver itself. Reports described a broad downdraft in mining shares alongside the futures decline. One widely followed gold miner fell roughly 6% in the same session that futures were sliding. Smaller miners fell even more. That's a tell because miners didn't suddenly lose their ore bodies. What changed was the market's ability to finance the narrative with borrowed dollars, and the selling didn't stop being a year-end story. In late January, COMEX gold futures trading volumes surged on certain days, while open interest began to slip, a classic signature of churn and deleveraging. One session showed estimated gold volume above 620,000 contracts, up from the mid-300,000s just days earlier, while open interest declined by thousands of contracts. The next session, volume remained above 500,000, as open interest fell again by more than 10,000. At the same time, the expert conversation split into opposing camps, and the contradiction itself became part of the signal. Some analysts frame the collapse as a necessary deflation of a speculative bubble, warning that parabolic commodities historically retrace violently. One former bank strategist went as far as warning about the potential for a 50% decline over a year, citing the rhythm of past commodity manias. Another camp argued that even if the futures market was overheated, structural industrial demand and supply constraints were real, and that volatility was the symptom of a tight market, not proof of a false one. In a leveraged market, the first margin hike is a warning shot. The second is a test of survival. The third is a regime change. And by mid-January, CME made the regime change explicit. On January 12th, CME issued Advisory 26019, effective after the close on January 13th, switching precious metals margins from fixed dollar amounts to percentages of notional value. 5% for the higher risk tier, 9% for the higher risk tier. That one technical change matters more than it sounds because it makes margin rise automatically as price rises. So the story isn't only that margins rose, it's that the system signaled that it no longer wants margin to be a debate. It wants margin to be a function. To understand why this hit so hard, you need to know what performance bond really means in practice. The number in the advisory is the exchange minimum for initial margin, the deposit required to open or hold the position. There's also maintenance margin, the level below which the account must be topped back up. And on top of that, many brokers impose their own house requirements, especially when volatility is spiking. So when you hear CME raised margin, what that often translates into is that the effective cash requirement for many traders rose even more than the headline number. CME's margin system is built around SPAN, a portfolio risk methodology that scans price and volatility scenarios and asks what the worst plausible one-day move might do to a portfolio. When markets start moving vertically, the scan range widens and required collateral rises. The higher risk tier you see in the notices is another layer, applied when positions are concentrated, near delivery, or otherwise considered more dangerous. That's why the HRP numbers jump first and jump higher. The system is designed to survive the day when everything goes wrong. Now add human behavior. They recycle capital, they run tight. So a margin hike becomes a forced liquidity event. Brokers issue calls, traders sell what they can, not what they want. They close the most liquid leg first. If silver is the liquid leg, silver gets hit. If the whole book is correlated, everything gets hit. And when price drops, variation margin flows the other way. Losing longs have to pay daily settlement. That cash payment can be larger than the initial margin increase itself. So the trader is being squeezed from two sides at once, higher required collateral and mark-to-market losses. That's how a normal pullback becomes a cascade. The proof that CME viewed this as more than a one-day scare is that the exchange kept acting. After the late December shock and the January move to percentage-based margins, reports in late January noted CME raising margins again after some of the steepest single-day plunges in decades. That's the clearinghouse staying in front of the next wave, even if it makes the current wave feel worse. Now, none of this happens in a vacuum. The reason a clearinghouse becomes aggressive is because volatility threatens the plumbing. Futures markets are built on daily settlement. Every day, winners receive variation margin, and losers pay it. When price gaps, the losers pay it part becomes a risk management problem because the clearing house is guaranteeing performance between every buyer and every seller. CME's job is to make sure that guarantee never becomes a question mark. Your job, if you're trying to understand the tape, is to recognize that when the clearinghouse moves, it's not trying to predict price. It's trying to survive it. This is not the first time we've seen this movie. In 1980, silver became a symbol of leverage and a warning about what happens when the rulebook changes mid-game. Prices soared through 1979 and into January 1980, touching near $50 per ounce on COMEX. Then, the exchange imposed restrictions that tightened the ability to buy on margin. The logic was the same: reduce systemic risk. The outcome was also the same: forced selling. By late March 1980, the episode culminated in what became known as Silver Thursday, with a dramatic collapse and panic across brokers. Fast forward to 2011, and you see the modern version. Silver had surged into late April 2011, and then, between late April and early May, CME raised silver margins repeatedly. Contemporary reporting noted that margins rose to about $21,600 per contract, roughly 12% of contract value from around 6%. Silver dropped hard, around 25% in a tight window. Again, the market didn't fall because every participant suddenly changed their view on silver's industrial uses. It fell because the amount of cash required to hold the same exposure changed faster than participants could adapt. Now look at 2025 into 2026. The pattern rhymes, even if the underlying demand story is different. In 2025, silver didn't just rally, it re-entered the public imagination. It also became a proxy for new economy infrastructure. Silver is used in solar, electronics, and high-density power systems, and the surge in demand narratives centered on that. In late January, a Financial Times report described silver around $112 and framed the move as a roughly 300% surge that was squeezing industrial users, especially solar panel manufacturers. It also put a number on the pain. Silver's share of solar module production costs rising to about 26% from about 3% 3 years earlier. That's a dislocation between the financial market's ability to push price and the industrial system's ability to absorb it. That's one of the hidden patterns. A price spike creates its own antidote. High prices invite substitution, thrifting, and recycling. Those forces don't flip a switch overnight, but they quietly bend the demand curve. And when the demand curve bends while the futures market is still operating on momentum, you get fragility. Let's talk about the players, because this is not the market acting as one organism. It's layers of institutions reacting to each other's constraints. First, there's CME Clearing and its risk management team. They set the minimum performance bond requirements because they are the backstop. They decide, effectively, how much leverage the system will tolerate. Second, there are the futures commission merchants and clearing brokers. They often require more margin than the exchange minimum, especially when volatility spikes. That's called house margin, and it can be the difference between a trader surviving a move and being cut. Third, there are the hedge funds, CTAs, and momentum strategies that live inside tight risk limits. Fourth, there are commercial hedgers, from miners to refiners to manufacturers, who use futures because they need to manage real exposures. And fifth, there are the banks and dealers who provide liquidity, lend against collateral, and decide when to widen spreads or step back. When CME raises margin, the first domino is not the long-term investor with no leverage. It's the leveraged trader whose position size was calibrated to the old margin regime. That trader either posts cash, reduces exposure, or gets reduced by force. And because reductions often happen across the same models at the same time, selling becomes synchronized. This is the part no one is discussing. A margin hike is a volatility event by itself. It can create the very volatility it claims to respond to because it forces positions to shrink regardless of price. That's why the timing matters so much. December 29th is not a random day. It's a thin liquidity window, a year-end window, and a window where many funds are already trying to lock in performance. Add a collateral shock, and you get a cascade. Now, what about institutional movement? What were the big players doing while this played out? One place to look is positioning data. Managed money positioning in precious metals has been shifting as volatility rose. In gold, managed money long positions that were in the 160,000 contract neighborhood in late December moved down into the 140,000s by late January, a notable reduction in speculative length. In silver, managed money long positioning in early January was measured in the tens of thousands of contracts, while short positions also shifted, suggesting a market where fast money was no longer comfortable being one way. Translation? Fast money backed away. But positioning is only one layer. Another layer is what the physical market does, while the futures market whipsaws. Here's the dislocation. Paper markets can print an ounce of exposure with a click. Physical markets have to source and move actual metal. When these two systems diverge, you see it in premiums, delivery delays, and regional price differences. In India, there were reports of an unusual premium in the spot silver market versus nearby futures, on the order of about R13,000 per kilogram. That's not a normal noise number. That's a signal that immediate supply is tighter than paper pricing suggests. At the same time, India's retail market saw bursts where silver approached the kind of rupee levels that forced exchanges to trigger circuit limits, while jewelry demand for gold reportedly fell sharply as prices moved too far, too fast. That's another dislocation. The financial bid can be strong, while end-user demand starts to crack, and that split cannot persist indefinitely. Either futures stabilize and pull physical down, or physical tightness forces futures back up. Or the market finds a new equilibrium through higher volatility and lower open interest. Those are the only real outcomes. Now let's put hard numbers on the mechanism, because this is where the margin call story becomes concrete. Start with the contract. COMEX silver is 5,000 ounces. If silver is $80, one contract represents $400,000 of notional exposure. 5% cash, 25%, 125%. Then shift to a percentage regime of 9%. And you're in a world where the exchange is explicitly saying, if you want to play here, you need to fund almost a tenth of the exposure in cash. And if price rises, that tenth rises with it. Now imagine a leveraged fund that runs, say, $50 million of capital and uses futures to express a view. If it had 200 silver contracts on at $80 silver, that's $80 million notional. 4 million posted, 5 million. 1 million of extra collateral for the same position in days. If the fund is also holding gold, platinum, or other correlated positions that are also being remargined, the cash demand compounds. And it compounds at the exact moment liquidity is lower and lenders are less accommodating. Think of it like a building during an earthquake. The building doesn't collapse because the concrete suddenly changes its mind. It collapses because the load shifts faster than the supports can adjust. Margin is the support. Volatility is the quake. When the supports get stronger overnight, the weakest structures have to shrink or fail. So what does the evidence say beyond the margin tables? The evidence shows a sudden synchronized repricing across metals and related equities. When silver fell sharply after the December 29th effective date, mining stocks fell with it. That's a tell. Miners didn't suddenly produce less metal in a weekend. What changed was the discount rate the market applied to a leveraged narrative. It became a liquidation trade. The evidence also shows that the exchange did not stop after one hike. It doubled down with a second hike on December 30th, and then shifted to a percentage-based framework on January 13th. That sequence tells you the clearinghouse saw volatility as persistent, not temporary. It saw the risk as structural enough to change methodology, and the evidence shows that the broader conversation fractured. Some experts describe the move as prudent risk management, necessary after a historic run. Others described it as pro-cyclical, the kind of policy that amplifies declines by forcing liquidations at the worst possible moment. Both can be true. Risk management can be rational for the system and painful for participants. Now, what does this mean going forward? Historically, when you see this combination, parabolic price action, margin hikes, and a shift in risk methodology, the market tends to enter a different phase. Not necessarily a permanent top, but a regime where volatility becomes the price of admission and where rallies are interrupted by violent clearouts. There are three broad scenarios that history allows. In a conservative scenario, prices stabilize as leverage is flushed out. Open interest declines, daily ranges compress, and the market rebuilds on a less leveraged base. That can look like boredom after chaos, but it's actually a necessary repair phase. In a moderate scenario, the market attempts to rally again, but each attempt is met with higher collateral demands and stricter risk controls, creating a stair-step pattern. Sharp rallies, sharp pullbacks, higher margins, lower participation. The trend can still be up, but it becomes harder to hold. In an aggressive scenario, the dislocation between physical tightness and paper leverage becomes so large that one side snaps. Either physical supply constraints force a scramble for deliverable metal, or paper liquidation overwhelms everything and drives price below levels that industrial buyers consider reasonable, triggering a wave of opportunistic demand. In both cases, the swing can be extreme. Notice what's missing. There's no guarantee. There's no certainty. There's only pattern. So what do you watch? You watch margin notices and methodology changes, because those are the rules of the game. You watch open interest, because it tells you whether the crowd is rebuilding leverage or exiting. You watch managed money positioning, because it tells you when fast money is leaning too hard one way. And you watch physical premiums and delivery metrics, because they tell you whether the real metal market is agreeing with the paper market. This is the choice ahead, and it's not about being smarter than everyone else. It's about being more attentive to the plumbing. Most people see a chart and think the chart is the story. The people who survive these episodes look at the collateral rules, the clearing mechanics, and the positioning data, because those are the forces that turn enthusiasm into liquidation. When the exchange raises margin twice in 1 week and then changes the entire margin framework 2 weeks later, it's telling you something. Volatility is no longer an exception. It is the environment. And in that environment, the divide widens. Institutions see the notices first, model the collateral impact, and adjust. Retail hears the story later, usually through price, and reacts. That's why information gaps become wealth gaps. It's not about secret conspiracies. It's about who monitors the system in real time. If this connected dots you hadn't connected before, you already know why we do this here. This is macro decoded, where we decode what matters before its headlines. And the question isn't whether margin can move markets. The question is whether you can recognize the moment the rules change before the selling tells you.